So last week, I'm up $50,232 from crypto. It took me 30 minutes of work, but I did spend about 5 years figuring out this system and making so many mistakes along the way. But right now I've got it set, I've got it figured out. It's consistent results without much effort. And I'm gonna show you the easy way to do all of this right now, starting with the secret. Ready? You can only make thousands each month if you aren't losing thousands first. And there's a problem with all this. When you bet on an individual coin going to the moon, you massively increase the likelihood that you're going to lose money. That's not a good engine for making monthly income in crypto. So instead, you want to build a portfolio that interacts with itself to stop itself from losing more than it brings in. Here's what I mean. I used to have a portfolio that was made up of like 50 plus, maybe even 100 plus tokens at one point, and I make more money right now holding 15 or fewer. This is because my portfolio supports itself. It supports itself kind of like a well-diversified stock portfolio does. I was thinking about how a well-diversified stock portfolio, like of a billionaire, how that functions. And it's actually pretty simple. All it does is selects investments in a way where any downsides from one investment are supported by an upside from another investment. So for example, oil stocks and airline stocks are traditionally negatively correlated. When oil goes up, airline stocks typically go down, which means if you own both oil and airline stocks, the relative risk of each investment goes down, and you're now investing in the overall growth of the economy instead of one individual sector. And if you zoom out on the economy as a whole, the economy trends upwards. So this can essentially work for you in crypto markets as well. This was the insight that I had. I can set up a portfolio where if one crypto or area of the market crashes, I've got other areas that are still doing fine, at least relative, to make sure that I still have profits most months. Now, yes, the whole market can crash occasionally, bringing everything down. And the crypto market is still very new, so there's a lot of bias towards what is Bitcoin doing and what are other tokens in the market doing. But there's still a truth to this. It's about finding the balance of crypto risks and rewards. No, it's not perfect, but it's better than just winging it. So I learned a few principles that you need to follow in order to do any of this. First, ensure your money is largely secured in high liquidity cryptos. This means their value is much more protected than low liquidity, more risky counterparts. Second, ensure that you have exposure to most of the key areas in the crypto market. This way you can capture different avenues of value, and I'm gonna go much more in depth in that in a second. And third, avoid overexposure to highly volatile coins. That way you just don't get wiped out. This is how I do it, using the entire market to capture and protect my money. In crypto, you have so many avenues to capture value. You have blockchains, exchanges, stable coins, serious projects with solid use cases, and fun projects like meme coins. You want to have a finger in each of these pies. This will help you achieve your two main goals: to capture value and to protect what you have. Those are our goals. Here's how I do it. Let me grab my portfolio. And first, let's look at USDC. This is about 10% of my portfolio in this stablecoin. Stablecoin, it's just like Tether, it's pegged to the US dollar. So in traditional investments, this would be like holding cash, which is something that you always want in your portfolio because you're less prone to fluctuations and you're able to seize an opportunity if something comes up really quick. This makes the overall portfolio more stable, which is going to come in handy later as we add more risk to this. So this is the most stable base. And if you follow my channel for a while, you'll know that I love lending out stable coins. Currently, I'm primarily lending out USDC on Coinbase. Here you can see how much I'm making and the payouts that are going directly into my account with zero work from me. Right now, they're paying 5.2% on essentially cash, and there's no lockup period. Like, it's a pretty good deal. Now, in the past, I've done all kinds of crazy decentralized yield farming to earn, 20% plus interest. And those deals do still exist in the market, but to be honest, I just haven't had the time to seek out or monitor those opportunities recently because it's a job to have 10 tokens, yield farming, make sure that they're still functioning properly, keep up with the decentralized exchange. It's a lot, but you can still do it if you have the time to do it. So I've been sticking with simple and safe more recently. And all in, I've made about $150,000 in passive income lending out stable coins and only stable coins in the last 3 years. Like, it's insane. There was a point in time a few years ago where you could make 180% APY on USDT in an exchange as safe as can be. Crazy. That doesn't exist anymore, but today's 5% APY And still, that's not bad for zero work and extremely low risk. Now, speaking of risk, let's look at my ADA holding. So I've got 2% about in Cardano ADA. Remember when I was talking about pies and wanting to get a piece of the action across the whole crypto market? Well, Cardano is a blockchain. But unlike most of them, it's based on peer-reviewed research and is developed through scientifically sound methods. Every single piece of their development is extremely rigorous. On paper, this is a wonderful way to approach a developing technology, but price-wise, Cardano could use some help. So it's still a bit of risk. I love the technology there, but we have to admit to the risk here. I think that this will do big things, especially in the long term, but I do get most of my Cardano upside exposure through a different investment, which I'll explain in a second. I still like to hold and stake some ADA though, in order to capture the potential value from the blockchain section of the market. However, there is more to the crypto industry than just blockchains. Like I said, that's just one piece that you want, a finger in one of those pies. So let's look at BNB. I've got about 3% of my portfolio here. But why? Well, BNB is the token of the Binance exchange, the largest exchange by trading volume in the world, as well as a very large blockchain network. Betting on Binance is like going into a casino, skipping the roulette table. You're like, I don't want to do roulette. I want to bet on the casino winning. That's kind of how I look at it. As long as crypto is a thing, Binance is likely to survive and be a thing because there's just so many people who use it to trade and buy cryptos. I believe they're going to continue to grow, so I hold their token to protect what I have. And this time we're creating protection via the exchange section of the market. So that's a blockchain, that's stable coins, and that's exchange covered, all capturing and protecting what I have from slightly different angles within the crypto market. Now I want to point out something. Note how much money I have in protecting my assets versus capturing value as the intended result of those assets. More than 10% in stablecoins and around 6% in capturing value from these big projects. Money is hard to make, but it's even harder to keep, especially in a crazy world like crypto. And although I've got other strategies for capturing value, which I'm going to share in a second, the theme of protecting what you have is going to ramp up the portfolio. It just works. So let's look at my investment in Render. Nothing big, it's 0.1% of my portfolio. It's a risky investment, so I give it a small allocation, but I'm a fan of its use case. Render is a serious project that helps individuals allocate unused GPU power to render things like graphics and visual effects. This massively helps free up access to what is normally a tech with pretty high barriers to entry, and it's just a use case that makes sense to me. And I don't see computer graphics going anywhere anytime soon, so I like it. I think that it warrants more attention, so I hold a small piece of my portfolio in this crypto. I do this to capture the value in case it starts getting the attention that I think that it deserves. It also covers the solid use case project part of the market. So that's one more pie that we're putting our dirty little fingers in. But I can go even riskier, and I have, because I have an 18% allocation in SNEC. Now, SNEC is a meme coin, and a meme coin is about as high risk as you could possibly get within this market, or within most markets, to be honest. It's the penny stock of the crypto market. So if you're looking at what I've done so far, this seems like a wild choice. Like, how does this make sense in relation to anything else that I've said? But hear me out here. First, I'm involved with the project. I'm a contributor, so I do look at this investment as equity in a startup, not as a passive investment. It's a much different angle that I'm approaching it from, but I am willing to personally take on the risk here because SNEC is doing incredible things that I'm not seeing other projects doing. They're building projects that actually earn revenue and buy back and burn community tokens on a large scale for a meme coin. So it has the pros of all the marketing assets of a meme coin, but they're actually generating revenue and profits with their product launches. Their latest product is called SNEC.fun. I used this thing a few weeks ago to create a token on it, and it gained over $150,000 in value in a single day, which totally caught me off guard and shows the potential of the project and this community. Plus, this is built on Cardano, so I believe that SNEC will help me capture even more upside within the Cardano ecosystem. So why an 18% allocation though exactly? Like, that's nearly double my holding in USDC, the stablecoin. Well, I'm in crypto. I'm in crypto to capture massive value. And a great meme coin with great branding, it's a shockingly good way to do that. It's crazy to say, but it is. I'm taking on a lot of risk here. If this was a passive investment, I'd probably be looking at a 1 to 4% allocation. Now let's change the pace, because I've got 8% in ETH and 53% in Bitcoin, 2 blockchains. Both of these are huge defensive picks. They have a few fundamentals that keep my money protected, and I intend to keep my money there. First, they're both very, very high liquidity, which means their price is more stable. They are just a more reliable pick. Second, they just work. I've had great results just dollar cost averaging into them over time. They return money. They're not going to just disappear like many cryptos under the top 20 could. Those could all theoretically disappear in a year or so. So all dollar cost averaging, all that means is buying a set amount of an asset every week, no matter what the market is looking like, no matter what your emotions are looking like. That also could be buys daily or monthly, whatever you prefer. But something like I buy $100 of Bitcoin a week every week on Friday. That's dollar cost averaging. But the vast majority of my money goes into Bitcoin because it's half of the entire crypto market cap, meaning the losses from random shit coins or my huge 18% portfolio risk on SNEC, they just aren't as scary when I hold that much Bitcoin. So if we look at this a different way, protecting my money, 74%. 53% of that is in Bitcoin, 8% is in ETH, 10% USDC, 3% in BNB. Capturing value is about 20%. 18% in SNEC, 2% in ADA. Now there are other miscellaneous cryptos that I haven't included, as well as funds that I strictly use for trading, but you can see that I am overwhelmingly safe while being exposed to the whole market and the potential upside of the market. And if we go back to the principles from earlier, I've got 100% of my portfolio spread across each section of the market to capture value, while 74% protection is in place to secure my money and stop me from being wiped out completely, even with my large investment in memes and other highly risky stuff. Meaning month to month, I'm usually in a place to make money with almost no work, all from the design of the portfolio. All I have to do is check in on these coins and the news and things like that a few times a week. It's easy. It's almost no work. 2 features of my portfolio help me do this. My capturing value investments allow me to take profits when they happen with very little impact on my overall portfolio. So I tend to take profits on my smaller, riskier investments quite quickly. So if I have something small that rockets up 50%, 100%, generally I'm out. I do that because I've learned the hard way so many times that unless you're purposely holding something for the long haul, like 5, 10 years, whatever, take your profits when you got them. Just do it, trust me. Alongside this, my investments in Bitcoin, ETH, and BNB are also pretty solid earners that grow over time. I do some Bitcoin trading, but for the most part, I intend to hold that long term. And then there's the added benefit. By dollar cost averaging, I get to capture abnormal returns within certain periods, like January to February 2024 for Bitcoin. So if I get outsized returns here, I can also take some extra profits if I want. I'm flexible in that way. I can maneuver however I need to. But I do need to mention that my entire crypto portfolio is only a piece of my whole investment portfolio. I own real estate, tons of government bonds, I have cash flowing businesses, I have other things that are happening outside of crypto, again, to help protect and all function together to kind of create a machine that is the right balance for me of safety and income. I only ever recommend you invest in crypto what you can afford to lose because it is risky. It is aiming for high upside. There's plenty of safe stuff that you can do that isn't this. And of course, there are many, many ways to make money, even in crypto. My head of research, Kyle, he has made $2.7 million himself, and he's taught multiple students now who have made over $1 million trading using his same strategies as well. So if you want to learn how he did it, check out this video here.